right, welcome. So again, the focus of this program, we're going to talk about credits, a topic that we love, at least I personally love, right, because it puts dollars in your pocket. So we're going to start, again, getting in here to some Chapter 6 topics with understanding the difference between a credit and a deduction. So again, we want to make sure that if I say, all right, I've got a sweet offer for you, I'm going to give you a $1 credit or a $1 deduction. My Rockstar Tax students, and you're going to say, well, that's easy. All right, I want what? What would I choose? $1 credit. Okay. What if I said, all right, I'm going to make this a little more difficult for you. $1 credit or a $5 deduction. What do we do now? Oh, I love that answer. Okay. Yeah, that's always a great tax answer, right? It depends. And what does it depend on? Tax bracket, right? Meaning what value, what benefit do I get for that $5 deduction, right? If I'm in the 10% bracket, well, it's only worth 50 cents to me, all right? $5 at 10%, okay? But if, let's say I'm in the 25% bracket, well, making me do some math there, $1.25, I think, right? So the point is the value of that deduction is going to change based on my tax bracket. But here's the thing. If I make $1 million or I make $50, a $1 credit is worth a dollar, right? There's no difference there, okay? All right, so that's going to be helpful as we kind of work through this to understand the difference. You know, we're going to focus this topic on some different credits that are out there that are available. Okay, first one, is it fair to say kids are expensive? A lot of us in the room can say yes, kids are very expensive, right? So the thought is you pop out a kid, all right, here's $1,000, okay? All right, Congress says, you know what, we're going to help you out. What now? How gracious of them, for sure. Is it fair to say that this is socially motivated? All right, this idea of, you know, again, we talked about different motivations as far as the tax law. Is it fair to say it's probably a social motivation? So, you know, we're going to give you a tax credit because kids are expensive, we're going to help you out. Okay, and the idea is we're going to help you out for your first 16 years. Once that kid hits 17, all right, go to work. Okay, Johnny, time for a job. Okay, so your first 16 years, you get that $1,000 credit. Now, what you're going to find with a lot of these credits is, again, that it depends. Tax answer comes in play. And really what it depends on oftentimes is your income. So for a lot of these credits, as I get over certain income, right, I got to be aware of the fact that I'm going to lose out part or maybe all of that tax credit. Now, again, my caution to you is not to memorize these thresholds, but just simply to be aware of it, right? So when you start looking at it and you're doing some math, you can figure out, you know, again, as my income gets higher, let's just make sure, look at what the thresholds are. But really what I want you to be aware of is if I give you 3, 4, 5 kids, you're going to look at age and figure out from an age perspective, do they meet the test? And just know that it's $1,000 per kid. And then as far as the phase outs, the thresholds, that's something that I don't anticipate asking you about on a test, okay? In terms of figuring out, well, how much do I get a credit for, right? But a big takeaway, again, $1,000 per kid, and you got to be under 17 at the end of the year. Okay. All right, so you got Bill and Melinda. Again, I tell you I'm not going to ask you a question on your test with the phase out, but I'm going to give you an example just so that you understand how this works. As far as Bill and Melinda here, 3 kids, right off the bat, what do you see? 19. That stands out to me and says, well, sorry kid, no credit for you, right? The 10-year-old, 3-year-old, we're good there. Right, so our max credit from a child tax credit perspective is what?
Oh, they can't have any because they're above the...
Okay, so we're going to find that they're above. You're right. So we'll have to deal with a phase out. And again, I didn't spend a ton of time on that phase out, but for every $1,000 you're in excess, in this case, Mary Family Joint of 110, you get a $50 cut from that credit. So we'll figure out how much their credit's going to be. But the max, if we didn't have to worry about any phase out stuff, for 2 kids, we're talking $2,000. Okay, so my starting point is $2,000, then I'm going to potentially chip away in this case because I got to deal with the phase out, right? But really what I want you to know, looking at that example, disregarding income, okay, so 2 kids, $2,000, right? I know that that 19-year-old isn't going to work. So those are the things that I would want you to pick up on for purposes of a test, okay? But in this case, you're right. Because we are over that 110 threshold, we're going to have a little bit of a reduction. So in this case, we're 4,000 because you round up, so it's 3,000 as far as that 113. But again, that additional $200 of income bumps us up another $50 as far as the reduction go. So again, $1,800 is what we're able to take as the child tax credit. Again, if the phase out stuff messes with you, if you're starting with that $2,000, that's I'm good with that. Okay, but again, just so that we're aware, right? Or the other thing to consider is there are times where you're preparing a return using the software. And again, software generally is pretty good, pretty smart. But all of a sudden you notice, well, I expected a $2,000 credit and I'm seeing $1,800, right? And so the way to think through that is, okay, does it make sense that there is some sort of a haircut, some sort of a cutback because of income, right? And if you're aware that, oh yeah, I think there is some sort of threshold, then that starts to make a little more sense, right? Whereas if you didn't know that, you'd be a little more confused. So, okay. All right, so let's spend a little bit of time here on earned income credit. Okay, so you're going to hear the term with earned income credit, it's a negative income tax. You think about the fact that, have you heard the term that it's roughly half, it's a little less than half, that do not pay any federal income tax? Does that sound familiar? We've kind of talked about that. And again, a big reason for that is this earned income credit. Okay, it's again called a negative income tax, which means you could potentially have zero tax liability and get a check in addition to that, right? Because of this largely in part, this earned income credit. Okay, so the idea, and just some things to be aware of with this credit. The amount gets bigger the more, hello, what am I doing? Getting excited, sorry. Okay, the amount gets bigger the more qualifying children that you have, okay? But let me just show you some of our thresholds here. Okay, so there's kind of a sweet spot. And again, that sweet spot changes each year, but it also changes depending on where you're at from a filing status and from a number of qualifying children perspective. To give you an example, let's assume that it's married filing joint, okay? So depending on how many children I have, my max credit is going to be different, right? So I could potentially be married filing joint, have no kids, get a credit, but again, we're limited to $487. You see that towards the top there, right? But if I got 3 kids or 7 kids, let's just say, okay, max credit of $6,044. And again, these are numbers that change, so please do not memorize any of this. But I just want you to understand the concept that, again, more kids, right, the more potential earned income credit. Okay. In terms of the phase out, let me show you another example here, right? So if I'm below this earned income amount, that top line, I'm going to get less than the maximum credit. Okay, so the more earned income I get up to that, the more credit earned income credit I'm going to get, right? But the point is, if I have $0 of earned income, guess what? I'm going to get $0 of earned income credit. Okay, does that make sense? So there is an incentive, certainly, to have some earned income. So let me ask you this question. Dividends, interest, are those going to count, do you think, as earned income? Okay, so wages, self-employment income, those are things that we're going to count for that earned income, right? But things like dividends, interest, alimony that's received, those are things that are not going to count for earned income. Okay, so the threshold amount, right, again, it's different if we're talking single surviving spouse head of household versus married filing joint. But the idea is if I'm in that sweet spot, so let's pick on like qualifying children 2, how about, okay? So if I'm in the sweet spot of, and if I'm married filing joint, let's say, so in between the 13 and the 22, excuse me, in that example, I'm going to get that max credit of $53.72. But guess what? As my income gets bigger and bigger beyond that 22, what happens? My credit's going to go down. When's it going to be 0? Well, once I get to that 48. Okay, that 48, $378. And you're thinking, man, I don't want to memorize any of that. Can I give you some good news? There's a table, right? There's calculations that you can do, obviously going online, to figure out the amount of your earned income credit. The point, right, is when you're talking about preparing returns or reviewing returns, you want to have a basic understanding of how this works, right? So that if you're expecting an earned income credit, you see roughly the amount that you'd anticipate. Or if there isn't an earned income credit, you can figure out why. Okay, so like for example, was working on a taxpayer this last week, expecting earned income credit, but realized that that alimony they weren't treating as earned income, which makes sense. Although I think at one point it may have been different. But because that wasn't considered earned income, even though there was income of 20 grand in that example, we didn't get to that threshold. We didn't have any earned income, so the credit wasn't calculating. Okay. Questions on this? All right. Okay, so the other thing to be aware of, so again, as far as our sweet spots, again, there's investment income. So to the extent that you've got, interest, dividends, royalties, let's say, that are in excess of $3,300, that's going to disqualify you from earned income credit. And again, I think married filing separate causes some issues as well as far as an earned income credit.
You may have already said this, but what exactly is the point of earned income credit?
That's a fair question. Anybody have any thoughts? What do you think? Why do we have the earned income credit? To help. Okay. Yeah, absolutely. It helps. But the way it's set up, what's the goal? To encourage working. Right? Working.
But not make too much money because
it
cuts off pretty low.
Uh-huh. Okay, you're right. So the challenge, and we can get into a really fun political discussion, right? Which we won't. No, that's okay. But you're right. So there's an incentive to work, but there's also the other argument is there an incentive to not work more? Yeah, too much. And so to the extent that that incentive is in place, then obviously there's concerns. But the idea of just in general, encouraging work, that was the original intended thought behind it. So
in that situation where once they're out of that spot, because it does cut off pretty low, but once they're out of it, then they shouldn't need it as bad.
Absolutely.
Then someone may gain from 5,000.
Yeah, no question. No question. But the point is, looking back at the table, you'll see 5,000. You're not going to be in that sweet spot, right? So at 5,000, you're not going to get the full credit. But if you end up more than that, then you would. But yeah, absolutely. So clearly, somebody at 5,000 is in need of some assistance. But again, the goal is if we encourage you to get up to, let's say, 13 with 2 dependents, you've now hit the sweet spot in terms of that max credit. And again, you understand though, let's say I'm at 13,410. It's not like I got earned income credit of 0. Okay, I'm still going to get a credit very close in this case to that 5372, but I wouldn't get the max. Okay. All right. Good. Okay. We good so far? Does that make sense? All right. So again, certainly a credit that can be very beneficial for taxpayers. So I think we had a situation this last week where we had an individual that had $8,000 refund, and yet a large part of that was earned income credit. So, okay, cool. So again, there are tables. So if you go to the back of your book, Appendix B is where you can kind of figure out and calculate the credit. One of the things to be aware of in terms of, it's talking about there in terms of taking the smaller of the 2 credits, you're going to look at your earned income and you're going to look at your adjusted gross income. And to the extent that your adjusted gross income is smaller than your earned income, you're going to use, you can use the credit that is smaller between those 2 numbers. Okay? So generally earned income is what you're going to use, but understand to the extent that your adjusted gross income gives you a smaller credit, that's the amount that you'll use. Okay? All right. So let's talk through this one. So again, child and dependent care. So the general thumb is we're talking about kiddos under 13. Okay? But obviously that doesn't just relate to dependents under 13. It could be that you've got a spouse or maybe a dependent parent that you're caring for that cannot care for themselves. So if you incur costs, or the thought is if you incur costs for that dependent so that you can work, and understand that really is the idea. So if I got husband, wife, okay, let's say wife's the breadwinner and husband's really good at fantasy football, okay, so drops the kids off at daycare so we can work on fantasy football. Okay, that's not going to work for purposes of this dependent care credit, right? The idea is both spouses have to have income that they've earned. Okay, now what if one spouse goes to school? Is that going to count? Is that going to work? Yeah, that actually does work just fine, right? So if I got a spouse that is going to school all year, we're going to find that they're going to be just fine as far as this credit goes. Okay, but the idea is I'm incurring these dependent care costs so that spouse, or excuse me, that the spouse or the provider, the parent of that dependent can work. Okay. All right, and there are situations where, let's say we got a divorce situation, and maybe it's the husband that's claiming the child from a dependency perspective, but ex-wife has custody. Okay, so the parent that has custody is going to be the parent that's going to qualify for this dependent care credit, even if they're not claiming that child as a dependent for purposes of exemptions. All right, so understand that distinction as well. So again, one of the things I wanted to mention, again, you can see this on page 6.5 in terms of the table, and again, this looks familiar probably for some of us from before. Okay, but one of the things that I really like about the way this credit is set up, what do you notice at the very bottom? It's kind of rare. No limit. Okay, no limit. All right, it's crazy. Wild, wild west. Right, no limit. So what it means again is, regardless of income, I can potentially get a 20% credit on those dependent care costs. Now, what if I got $2 million to watch Junior and the cost that I incur? Is that going to work? It's 20%, but it's capped in terms of times what number. So we're going to find that the amount that I can use for dependent care costs is going to be $3,000 per kid, or $6,000 for 2, 3, 4, 8 dependents. Okay. What now?
It's like 4 months of the year.
Yeah, exactly. Well, and so that's the thing. So like we had a situation, tax return we're working on this last weekend, right? Trying to figure out where we're going to get to, 3,000, because she only had part of the year's worth of information with her. But the question was, okay, are we going to get to 3,000? If we're going to get to 3,000, then we don't have to worry about it, right? Because that's our cutoff anyway. So if we're going to get above 3,000, then we can just run with that number for one dependent. Okay. The idea, again, so the fact that I've got to provide the taxpayer ID number for the caregiver, and again, understand that caregiver could be a relative. Okay, as long as they're not your dependent, you could be paying a relative, let's say, to watch Junior while you work, right? But why am I providing an ID, do you think? What's the IRS looking for? You're taking a credit.
To make sure that they're putting it on their earned income.
Jackpot, right? So they're trying to match, to say, hey, if you're taking a credit, we want to know whoever's receiving that money, it should be income to them. Yeah, absolutely. Okay. As far as what kind of expenses qualify, so again, certainly an in-home daycare is fine, out-of-home daycare is fine. Camps, interestingly enough, are fine as long as, again, it's not, if I'm not sending my son or daughter, let's say, to kindergarten, okay, that's not going to work, right? But if it's something outside of school, something outside of education related, it's going to qualify.
What
Question?
About, like I know when I was in school we had this, it's like a after school daycare. It's at the school.
That's fine.
Okay.
Yeah, the issue is not that it's at the school. The issue is it, if it's kindergarten, kindergarten's not going to qualify. But if it's after school care at the kindergarten, that's totally fine. Yep, no issues. So again, what you notice there, right, is if you're in school, so the red stuff at the bottom there, if you're in school, well, let me back up a step. As far as the credit, right, so my example where you had husband that was staying home doing fantasy football, right, when you're looking at the expenses that you can use for purposes of this credit, it's the lesser of earned income for the lowest earning spouse. So in that example where husband's doing fantasy football and earned income of 0, right, you're not going to have the ability to take the credit, okay? So again, earned income or $3,000 for one kid or $6,000. So generally, if you got both spouses working and they're making at least $6,000, let's say, right, your limit is going to be what you spent for daycare in terms of that $3,000, that $6,000. And again, to your point, Kelsey, it doesn't take very long to get up to $3,000 or $6,000, right? Absolutely. Sure. Absolutely. Okay. So again, the idea to figure out the credit is it's the amount of expenses, again, max of $3,000 for one kid, max of $6,000 for two and up, times a percentage. So the credit could be very different even with the same expenses depending on your income, right, your adjusted gross income, okay? All righty, very good. So we got Bonnie and Clyde, okay, sorry. Salary $58,400, investment income $2,100, 3 kids, daycare cost of $12,800. I'm thinking, do I care about the $12,800? What do you think?
Yeah.
I'm limited to 6. So $12,800, that's nice, but I'm well over my 6, right? Okay, so what's the issue though? So Bonnie's got some income, and Clyde's a student. Is that going to be okay? Are we good there from an earned income perspective? Yeah, absolutely. We're going to be just fine there. Okay, but if instead, so the second question we're going to answer here is, what if Clyde only earns $3,000 working part-time? That's going to change our answer, obviously, right? So the initial credit there, right, when he's in school all year, is $6,000 times 20%. So again, as far as the percentage, right, if I back up to, what now?
The 43.
Yeah, they're over the 43. Yep, exactly. So again, even just based on her salary alone, that got them over the 43, right? And so we were at 20% as far as the credit, okay? But the issue when it comes down to that second example, right? He only made $3,000. Okay, so even though they had $12,000 in expenses, $12,800 in expenses, even though they could have used $6,000, right? It's the lesser of earned income for the lowest spouse or that limit. Okay, so in this case, we had to use $3,000. So, all right, so the credit went down, cut in half. So, all right, I love this credit, very much so. Okay, school, is it expensive, or can it be expensive? Yeah, it can be pretty expensive, right? The sweet thing about this American Opportunity Credit, so again, 4 years, okay, $2,500 credit. If I spend $2,000 on school, Congress writes me a check for $2,000. Sweet. Thank you very much, all right? Understand that 40% is refundable, okay? So be aware of that, right? That again, I could have a maximum, so again, if it's a $2,500 credit, I could have a maximum of $1,000 be refundable, okay? Nothing more than that. All right, so as far as things that qualify for that credit, certainly tuition and fees, right? The nice thing about your books is it doesn't have to be books that you purchase and are required to purchase through the school. So let's say you go to Amazon and you buy your books that way, right? As far as this credit goes, those books are going to count for purposes of that American Opportunity Credit, okay? But here's the thing, right? You got to think through, if I'm going to be at expenses greater than, in this case, $4,000, doesn't matter. So once I get to $4,000 in expenses, I'm going to max out that American Opportunity Credit. And some of you are thinking, well, how do I get to $4,000? Well, again, so the first $2,000 is a dollar for dollar credit, okay? The next $2,000 of expenses is at 25%. So $4,000 of expenses will get me to a $2,500 credit. That's kind of how that works. Sorry, but you can't be convicted of a felony drug conviction, right? So hopefully we're okay there. Be aware, this trips some students up sometimes. If I'm just taking a class here, class there, oh, I kind of like to learn, right? That's good, right? Nothing wrong with that, okay? Lifelong learner. You're not going to work, that's not going to qualify you for this American Opportunity Credit, okay? So you've got to be half-time for one term, okay? So again, a full-time is 12 hours, and you got to make sure that you're taking at least 6. And part of the idea, too, is you've got to be in a degree-seeking program, right? So you're going with there's a goal in mind in terms of pursuing a degree.
What does it mean 40% is refundable?
So of the $2,500 credit, 40%, which works out to be $1,000, is refundable. So, but the thing is, if I have less than a $2,500 credit, it's going to be less than $1,000 that's refundable. Yep. So. Okay. All right, so lifetime learning is another credit to be aware of. Okay, the bummer with lifetime learning, it's not quite as good. It's not that dollar for dollar credit we're talking about as far as American Opportunity. I should mention, just backing up a step here real fast, okay, be aware there are some income limits to deal with in terms of once you get over certain income limits, you're going to not qualify for the credit. Same deal with the lifetime learning. The limits are lower from an income perspective before you start having issues taking the credit. Again, it is tuition fees only, so books, it's kind of a bummer. But again, if you're somebody that I'm taking a class here, taking a class there, right, you can get 20% of that covered as part of this credit. Understanding, and so it's not refundable. There isn't a refundable piece to this, so if you don't have tax liability, you're not going to get the benefit of the credit. The nice thing too, let's say I've exhausted my 4 years with the American Opportunity Credit, but I'm still going to school, right, because I love learning, or it's taking me 8 years to do my program, right, whatever the case may be, this lifetime learning is going to be your friend, okay, as far as the credit. Because again, once you've used 4 years of American Opportunity, you're now, lifetime learning is your best bet generally, okay? Again, there is a tuition fees deduction, which is a possibility, but again, oftentimes you're still going to be better off with this credit. Questions on this one? So again, general rule of thumb, if I'm taking a class here, a class there, lifetime learning is going to be the credit I'm going to take. If I'm full-time degree seeking or even half-time pursuing a degree and I'm in my first 4 years of undergraduate, then the American Opportunity. There are times, I was talking to another preparer a couple weeks ago, and she said there are times where she advises students, she says, you know what, if you just have a little bit of expenses this year, but you're still probably going to have 4 years of school, she says, you know what, wait on that American Opportunity. If you think you're going to have 4 years in a row where you got at least $4,000 of expenses, and it's not this year, as much as it'd be sweet to take the credit this year, you can only do it 4 years. So it might be worth delaying pleasure a little bit. Wait till next year when you've got more expenses and get your full bang for your buck. So that's something to kind of think about too. So you make sure you don't use up your years of eligibility with that American Opportunity credit. Lifetime learning, you can take it till you're 90, even beyond 90. There's no limit. I just made it 90. So, okay. I can't use the same expenses for both credits. I can't double dip. Does that make sense? So it's one or the other. Now again, I could, let's say I got 2 students or 2 dependents. I can do lifetime learning for one and American Opportunity for the other, but I can't do both credits for the same student. Okay. Certainly, and this is something that is kind of catches students by surprise sometimes. If I've got $10,000 of expenses, but I have a $10,000 scholarship, I don't have any qualified expenses, general rule of thumb, right, for purposes of these credits. Okay, because again, I had a scholarship or grants, let's say, that covered the cost of that school. Okay. All right, so let's look at an example here. So we've got Jesse and Val, 2 dependent children. So we've got Sean taking 4 credits, so it's part-time at a city college. And then we've got Corey, who's a freshman enrolled full-time. She's got big old fat tuition fees of $39.2. Makes you thankful you're here at Johnson County Community College, right? Where it's not $39.2. Okay, not that there's anything wrong with Tulane, okay, but just obviously a lot more expensive. So immediately looking at those 2 students, so Sean and Corey, what do you think? Are both of them going to be American Opportunity? Both of them lifetime learning? One of each, maybe? What do you think? Help me out here.
Both are the lifetime learning.
Lifetime learning, okay. So what's your concern with Corey in terms of not qualifying for American Opportunity? What do you think?
Doesn't he have to be full-time? Am I missing this?
Yeah, so she is full-time. Yep, for sure. So,
Oh, not
the second
her.
kid.
No.
Okay, so Sean, yeah, so it's half-time actually as far as American Opportunity. But so
Oh.
Sean's not going to work because he's not taking enough classes, right? So 4 credit hours is not going to be considered.
Well, but it says part-time enrollment.
Yeah, it says.
Wait, what?
Yeah, so we're not going to meet the test for American Opportunity for Sean. Okay, not going to school enough, right? Not at halftime. Okay, for purposes of American Opportunity. So we're thinking lifetime learning for Sean, first kid.
Well, it says student must be at least half-time.
Right. So taking 4 credit hours.
Oh, I just looked at part-time enrollment.
Yeah.
Okay.
So yeah, assuming if full-time is, and again, most cases full-time is 12, right? Sometimes some schools it's 15, but let's assume it's 12, right? So regardless, for part-time, we're probably not going to be able to get to American Opportunity. But for the freshman that's full-time, are we going to be okay there for American Opportunity, do you think? Yeah, I think so, right? So again, I would argue one of these students, so Sean, we're going to probably take lifetime learning, okay? And Corey, we're going to be able to take the American Opportunity. Okay, so the full $2,500 credit for Corey, right? Sean, again, we're at 20%. Okay, again, up to $10,000 of expenses. And so in this case, the $4,200 times 20%. All right. Questions on that? So do we kind of understand the distinction? I know we had some questions or some confusion maybe. You're good now? Okay. Sorry about that.
No, you're fine.
All righty. Good stuff. So again, 2 students, we took 1 credit for each of them, right? It was different, and that's okay. Understand, so just backing up to some stuff from chapter 5. Could I, let's say I was smart and I had a 529, a qualified tuition plan, and I pulled out, especially for Corey, because man, 39.2, that's ridiculous, okay? What if I pulled out 36 from the qualified tuition plan? Sorry, 35, let's do 35. So I pulled out 35, and then I wrote a check for 4,200. Does that seem like a good plan? Destiny's saying, I like that plan. Yeah. Because what did I just do? I used my qualifying tuition plan, which said, hey, if I use this for school, your earnings, tax-free. Okay? But I still wrote a check for 4,200 so that what? So that I could get that $2,500 credit. So that, my friend, is great tax planning. Okay? So for each of you, I hope that we are able to do something like that. Okay? At some point. All right? That is using the tax system legally to your advantage, which is always the best way to do it. Okay. All right, so we're going to cover one more topic, and then we'll take a break here. Okay, and practice this first with some in-class stuff. All right, so foreign tax credit. So here's the bummer about the U.S. tax system. Okay, I've got to include in my income that I earned everywhere, in the U.S. and abroad. Okay, so that's the bummer. Here's the good news. There's what's called a foreign tax credit that says, hey, if you pay taxes, income taxes, elsewhere on income that you earned elsewhere, the U.S. is going to give you a credit on your U.S. tax return, your 1040. Okay? But here's the bummer, though. Let's say, what's a really high tax jurisdiction? I'm trying to think. So certainly a lot of the European countries. Let's just pick on Germany. Switzerland? It's pretty high, too, right? Germany's high.
40.
Okay. So a country, let's say over there in Europe that has pretty high taxes. Let's say a country that's got 50% tax rate. How about? Okay. Is the U.S. tax rate? It feels like 50, but is it really 50? The highest rate in the U.S.? No, it's less than 50. Okay. So the point is, what we're going to find is when I pay taxes somewhere else, and if it's a rate higher than the U.S., I'm going to get a credit for that tax that I paid here in the U.S., but it's not going to be everything, dollar for dollar. Okay? But let's say instead I paid taxes to a jurisdiction that had really low tax rates, something less than the U.S. Okay, we're going to find in that example that I'm going to get a full credit. Some of you have worked on situations where you're working on a Missouri return and a Kansas return. Does that sound familiar? So you're getting a credit in your resident state for taxes that you paid in your non-resident state. It's the same way where the resident state is looking at, hey, what would we have taxed you on that income? And that's the amount of credit, the maximum credit we're going to give you. So if I work in Kansas, if I live in Kansas but did a bunch of work in California, does California have pretty high tax rates? They do. So Kansas says, you know what, we're happy to give you a credit, but only up to the rate that we would have charged you on that income, not what California charged you. It's the same deal with this foreign tax credit, right? Where you're going to get a credit for taxes you paid to other countries, but only up to the rate that you would have paid here in the U.S. So again, I think an example is going to be really helpful. But understand that the way we're going to look at this, we're going to say, okay, how much income did I earn foreign, abroad, okay, not in the U.S., compared to how much income did I earn everywhere, including that foreign income, okay? And I'm going to multiply that by what's my tax liability on everything. And that becomes the amount of my credit, okay? All right, so let's look at an example. So we've got Joe, Lithuania. That's a good example of high tax rate, okay? So the idea here, right, 200 in the U.S., 100 abroad, so we're at 300 total, okay? So 40,000 in taxes in Lithuania, right? Do you think we're going to be limited, potentially, just kind of right off the bat when we look at this? What was my tax that I paid? What percentage in Lithuania? 40 over 100, so 40%. Okay, so we're going to find that I'm going to be limited in the U.S. because the tax rate, again, is not 40% in the U.S. Okay, so the way the math is going to work here, right, is how much of my income was earned abroad. What do you think?
100.
100 over 300, or a third, right? From a percentage perspective, a third. So the fact that a third of my income was earned abroad, guess what? The max credit I'm going to get is a third of that 85,069. Okay, so what we're going to do is compare how much did I actually pay in taxes, which is the 40, to what is a third of the tax that I got to pay in the U.S., which is 28,356. And guess what? I don't get a credit for 40, right? I get a credit for 28,356. Okay? I think essentially what's happening here is Congress is saying, all right, we're willing to give you a credit, but only up to the rate that we would have charged you on that income. Because we want to be able to tax you on that 200 that you earned in the U.S. We want the money for that. Does that make sense? We're willing to give you a credit for the 100 that you earned abroad, but the 200 that you earned in the U.S., we're going to tax you on that. Okay.
If you only earn money abroad, do you still get taxed by the U.S.?
The great answer there is it depends. If I only earn money abroad and it's at really high taxing jurisdictions, I'm probably not going to pay any U.S. tax. But if I earn money abroad, and let's say Bermuda, I think has a pretty low tax rate, right? So if it's only Bermuda, right, and again, as a U.S. citizen paying taxes here in the U.S., my credit for taxes paid elsewhere is going to be pretty small, so I'm still going to have a sizable U.S. obligation, yeah, in that example. So, yep. And again, the nice thing is as far as those foreign taxes that so again, in this example, I paid 40, I only got a credit for 28 and change. So whatever's left over, I'd get the ability to either carry it back a year or use it in the next 10 years as a carry forward. So it's not that I lose it forever, I just can't use it now, okay? But what you'll find is that there are some individuals that if I'm consistently working abroad and consistently working abroad in really high tax jurisdictions, some of that credit I'm just never gonna get it, right? Because I'm consistently paying a higher rate than what I would pay in the U.S., okay? So that's when it's time to start moving to somewhere that's got a really low tax rate so you can get the benefit of that foreign tax credit. So, alrighty, so I think we're at a stopping point. So here's what I want to do. I want to take a few minutes, go over that side 1, which is the 1, 2, and 3 in-class festivities from chapter 6. So take a few minutes, work on that. We'll go over it, and then we'll take a break, okay? right, great. So we'll spend a few minutes here talking through this in class, making sure we feel good about these different credit scenarios. So let's take a look for starters. So we got Joe and Amy here. Let me move the textbook. Okay, so we're talking dependent care credit here, right? And they've got 2 kiddos. Okay, $8,000 of qualified expenses, but do we care that it's $8,000, or are we going to have to cut that back? We're going to have to cut it back to 6. Okay, AGI of 34, that's going to be helpful. And the fact that it's earned evenly, do we have any issues as far as spouses earning? Yeah, so they each earned at least 6, right? So as far as the amount of their credit, what did you get as far as your percentage?
25.
25? Okay, good. That's what I got as well, right? So again, this is the kind of thing, something like, you know, this chart I would provide to you, all right? So if I had a question on your exam, that's certainly something I would give to you in order to answer that question, all right? So 25%, and is it times 8,000, or is it times something else? Times 6? Yeah, for sure. So times 6,000, because again, max of 6,000 for 2 or more dependents, right? Max of $3,000 for 1 dependent. So if my math is correct there, we're at a $1,500 credit.
Could those amounts change year to year, depending, or those?
The 3 and the 6?
Yeah.
Anything could change.
Just checking.
But as far as long as I can remember, it's been the 3 and 6. But yeah, it doesn't mean that won't change. So if anything, it's going to go up, which would give you a bigger credit over time. So, so yeah. So it's, if you're revisiting this 5 years from now, it is worth looking. Is the point, to make sure that those have not changed. But the concept, I would imagine, would stay the same in terms of it's a different credit depending on income. So, okay. All right, so we'll look at some education credits here. So again, we're initially going to talk American Opportunity. All right, so $10,000 of expenses, tax liability of $4,000. So what do you think as far as his American Opportunity credit here for A? What'd you get?
2,500.
Yeah, the full 2,500, right? So we're going to find that we're at, again, we can use $4,000 of expenses to get us to a $2,500 credit. So again, the first $2,000 dollar for dollar, the next $2,000 at 25% gives us a $2,500 credit. And again, the fact that his liability is 4 means it's going to reduce it down to $1,500. 4,000 minus the credit of 2,500. Does that make sense? Okay. So for B, mix it up a little bit here, right? Tax liability is $1,200. So what's our issue as far as that credit? Is it all refundable?
No.
Only
40%.
40%, yeah. So 1,000 of that credit is refundable. So I think we're going to end up here, total credit of $2,200, right? So we'll wipe out our liability, okay? We'll have 1,000 that's refundable, but only 1,000. And the idea here is, let's say I only had 3,000 of expenses instead of 4, right? That's going to change my the amount that's refundable to something less than 1,000. Okay, so it's only 1,000 to the extent that I've got at least 4,000 in expenses. Okay. All right. So we wipe out our tax liability, we get to 2,200, including the 1,000 that's refundable. All right. So for C, and forgive me, we're going to assume we're back to that 4,000 liability, all right? Because again, this lifetime learning credit, non-refundable, all right? So I can use up to 10,000 of expenses times 20%. So I'm going to get a $2,000 credit, all right? But again, so if I'm part-time, so Jennifer, to your point, right, we're assuming that we don't meet the half-time requirements there. So I agree, a little bit confusing. So I will try and do my best on a test to make you not have to guess. Is that fair?
I'm really thrown off by this whole tax liability thing. I may be the only one, but
Okay.
like
Okay,
what
here's
is
the
that?
point though. Let's say my tax liability was $1,000. So this lifetime learning credit is non-refundable, which means that credit can wipe out my tax liability, but I can't get a refund in excess of that. So I'm limited to whatever my tax bill is just prior to this credit, if that helps you.
Why is C 2,000 instead of 2,500?
Okay, so C is the lifetime learning credit. So with C, because because in this case Trevor's enrolled part-time, he doesn't qualify for the American Opportunity Credit. So, so instead of the dollar for dollar up to the first 2,000 and 25% afterwards, so again, that's what we saw for A, right? So instead of that, he's stuck with, and again, still $2,000 credit's not bad, right? But he needs to use lifetime learning because he wasn't a half-time student. So, okay. Also, for example, if I've used up my 4 years, right, of that American Opportunity Credit, anytime after that, I'm going to be having to use lifetime learning. Okay. And the reason why American Opportunity is so much better, again, in this example, he had 10,000 expenses. But what if it was 4, 5, or 6, right? Well, in that case, I'm still going to get a $2,500 credit American Opportunity, right? But my lifetime learning is only 20% of that amount, so it's much lower than 2,000. Okay. But again, the thing to be cautious about, right, because only 1,000 of the American Opportunity is refundable and the lifetime learning is not refundable, all I can do is wipe out my tax liability. I can't, for that lifetime learning, I can't go below it. Okay. Because, for example, if I had stuck with B, where I had liability of $1,200, even though this comes up with a $2,000 credit, guess what? I can only take $1,200, right? Up to my tax liability. And understand, my tax liability has nothing to do with what I had taken out of my paycheck, withheld, that kind of stuff, right? It's just based on taxable income. What tax do I owe? Is what we're looking at there. Does that help you a little bit, hopefully?
No,
So,
I guess I don't understand what it has to do with.
Okay.
Because
so,
he paid $10,000 in qualified
Right.
expenses
Uh-huh.
to school. So what does the $4,000 have to do with anything in that perspective, like the
the
education,
$4,000 of expenses, or the $4,000 tax liability.
the tax liability?
So the tax liability, the issue there is I want to make sure, because for the American Opportunity Credit, I can only have 1,000 refunded. So if I don't have enough tax owed, I may only be able to get $1,000 refundable. So if I had no tax liability, all I can get is 1,000 refundable. But if I did have some tax liability, I can get a bigger credit up to a maximum of $2,500. So I needed to know first that I owed some taxes so that I could get the benefit of the non-refundable piece of the American Opportunity Credit. Or like lifetime learning, for example, all of it is non-refundable. So if I have no tax liability, even if I have qualified expenses, I get no benefit. Okay, and I will say most of the credits are actually non-refundable. So most of the credits, if you got a liability, great, it reduces your liability. But if you don't, you lose the benefit of the credit. Earned income credit is a great example of one that is refundable, though, which is why you could end up with a big fat refund, right? Even if you don't have a tax liability, you could still have that money refunded to you. Okay. Alrighty, fair enough. I'm showing you more than I want to, but that's okay. So here's the idea, right? How much tax did Jimmy pay? That's what we want to start with. Income of 50, 40% rate, so 20,000 tax was paid. Does that make sense? We'll start there. Again, sometimes I'll be nicer to you and give you the actual amount. Sorry, I didn't do that this time. Okay, but based on income earned abroad, tax rate of 40%, 20,000 of tax was paid. So the way to think through this initially with this foreign tax credit, right, is the maximum foreign tax credit that I can get is what I paid, which is 20 grand. Okay? But here's the problem. To the extent that the rate I paid abroad is higher than what I would have paid on that income in the US, my credit is going to be limited. And that's what we're going to find here, right? So I had 50 abroad, US sources of 150, so my overall income was 200. Okay, so of the 60,000 tax liability, 25% of that, or 15, relates to Germany, right? Relates to my income from Germany. So the foreign tax credit here is not 20, it's going to be 15. Okay, let's say instead Germany, it was a country that has a very low tax rate, 10% rate. Okay, So instead of 20,000, I paid tax of 5. Am I going to get a full $5,000 tax credit? Yeah, absolutely. All right, so in that example, when I've got a really low tax rate elsewhere, we're going to find that the lesser of those two is going to be what I actually paid in federal, or in foreign taxes, excuse me. Okay. Questions? So again, this is one that you will actually see on your test, a calculation like this. This is probably something that you're going to want to put in your notes to make sure that you bring that in with you. But the point is, I do get a credit for taxes that I pay elsewhere, but depending on the tax rates abroad versus in the U.S., I may not get a full credit. And again, the best example we can think through is those of us that have done 2 states. You see that same concept. We good? Take a break? Let it marinate up here a little bit? Okay, let's do that. So take a break.